John has 2 DORA a day and one simple goal to generate 9 DORA. Happy a month in dividend income, and on the surface that sounds completely reasonable until you see what happens when he follows the same path most investors take. If John does what almost everyone does and puts that money into the SP Go, the numbers look fine at first: steady growth, strong returns, and a simple strategy that works over time. But when you actually run the math, something uncomfortable shows up. It would take him 9 years to reach that 9 packs a month target. That's not a plan, that's a lifetime most people don't even get. And this is exactly where most investors get misled, because the SPJO UTAC doesn't fail, it just delivers too late for the kind of outcome people actually want. So in this video, we're going to break this down properly, not just surface level advice, but the real mechanics behind why this happens, what changes the timeline, and how the same shooter a day can produce a completely different result when the structure is right. We're going to walk through what a dividend snowball actually is, why it behaves differently from traditional growth investing, and how that single concept can compress decades of waiting into something much more realistic. Then we'll build a 5-stock portfolio step by step, not based on hype, not based on chasing the highest returns, but based on a balance that actually works in the real world. And we'll show how that portfolio reaches Neen Daru by happing a month in just about years instead of Negru. And if you stay all the way to the end, I'll show you one simple adjustment that cuts that timeline even further down to just Jusan years, which is where things start to feel very different from what most people expect investing to look like. But before any of that works, John had to answer one question first, and it's the question almost nobody asks clearly enough. How much money do you actually need to generate Nidura Hoppier a month? Because without that number, everything else is just guessing. And the answer comes down to one variable that quietly controls everything in dividend investing: yield. Yield is simply how much income your investments produce relative to how much money you have invested. And that 1% completely changes the size of the problem you're trying to solve. At a pasendani yield, which is roughly what the SP Goya pays, John would need about Idoro by the Shurju, by the 2 million invested to reach Nidor. 1 by a month. And Pasendasan, that drops to around 2 million. At Pafendashi, it falls to roughly Yoturong Yun cents Rosero. And at Pashendo, it comes down to about Loju Shimanjus Sendu. Same income goal, completely different mountain to climb. And this is where reality hits, because most people don't have $1 million sitting around waiting to generate income. If you're trying to reach that kind of monthly cash flow, it's not about having money already, it's about building it efficiently over time. That's when John realized something most investors completely overlook. The path to income isn't just about how much you save, it's about how hard your money works while it's sitting there. And once you understand that, a second piece becomes even more important, something that turns a slow process into an accelerating one: dividend reinvestment. Because instead of taking the cash your investments pay you and spending it, you feed it right back into the system, buying more shares, which then produce even more income, which then gets reinvested again. And that's where the entire dynamic changes. Your money starts working in layers. The original investment produces income. That income buys more assets, and those new assets start producing income too. It becomes a loop that builds on itself, a snowball. And at the beginning, it looks small enough to ignore, but over time, it becomes the single most powerful force in the entire strategy. The only real question is what you feed that snowball with. Because John tested the exact same snowball using the SPCOM, and the result wasn't what most people expect. To understand why the SP job struggles to deliver income early, you have to look at what it was actually designed to do, because the SP job is not built for cash flow, it's built for growth. And those are two very different outcomes, even though they both fall under investing. Historically, the SP delivers strong price appreciation, averaging around Pasendoju to Pasendoju 9 per year over long periods. And on paper that looks excellent, because the account value keeps climbing and compounding does its job, but there's a problem hiding underneath that growth. The dividend yield sits around Pasentany, sometimes even lower. That means even when the account grows, the actual cash it produces stays small for a very long time. So John takes his yundra a day, which adds up to Shenzhen Lobakwa yundra a year, and starts investing consistently into the SP. Well, Biak with every dividend reinvested, doing everything correctly, no mistakes, no interruptions, just discipline and time. After 2 years, his portfolio grows to around Rogman Hasendor, which feels like progress. But the dividend income at that point is almost invisible, barely enough to notice, because passenity of that number doesn't move the needle in real life. After 500 features, the portfolio reaches roughly 500 features, which sounds significant, but the annual dividend income is only about 1 CEDA, which is less than $1 na IM a month, and that after 2 decades of consistency. After Sanji years, the account finally crosses the $1 million mark, around it 10 to dur million, and this is where most people expect life to change, but the income still tells a different story. The dividends come out to roughly Sanjing dor per year. That's about 95 Ju dor a month. $1 million portfolio producing Niba for Ju 3 a month. And that's the moment where the disconnect becomes obvious. The account grew, but the income didn't. The SP Go hack and did exactly what it was supposed to do. It compounded, it built wealth, but it delayed the part that actually matters for income-focused investors, which is cash flow. The curve is heavily backloaded. For decades, it barely feels like anything is happening. And then most of the growth shows up at the very end, long after the timeline most people actually care about. That's why it takes 9 leap years to reach 9. 9 Judah, very big a month, not because the strategy is broken, but because it's optimized for the wrong outcome. So instead of asking what grows the most over time, John started asking a different question. What pays the most the soonest without taking on unnecessary risk? And that shift changes everything, because once income becomes the goal, the way you select investments has to change as well. You're no longer chasing the highest returns on paper, and you're not chasing the highest yield blindly either, because both extremes come with problems. High growth with low yield delays income. High yield with no stability risks losing everything. So the real objective becomes balance, a combination of yield, growth, and stability that works together instead of against each other. And this is where most investors make mistakes, because they tend to focus on just one of those 3 elements instead of all of them at the same time. If the yield is too low, the income takes too long to build. If the yield is too high, the dividend often isn't sustainable. If there's no growth, the income loses power over time. And if there's no stability, the entire system breaks when conditions get difficult. So John builds a simple framework. First, he looks for a yield between Pasantoni and Pasento Luke, high enough to matter, but not so high that it signals risk. Second, he looks for strong dividend growth, ideally around Pasento per year or more, because that growth is what accelerates the snowball over time. And third, he looks for stability, companies with consistent cash flow, reasonable payout ratios, and the ability to keep paying even when markets get rough. Because if the dividend gets cut, the snowball stops rolling. With those 3 filters in place, the strategy becomes much clearer. You're not picking random stocks anymore. You're building a system designed to produce income, grow that income, and keep it running long enough for compounding to take over. And once that system is clear, the next step becomes simple. Choosing the actual investments that will drive it. That's where things start to get interesting. With the framework in place, John stops guessing and starts building the portfolio piece by piece. And the first thing he needs is a foundation, something stable, diversified, and already built around high-quality dividend-paying companies, so the entire system has something solid to grow on. That's where he starts with Schwab US Dividend Equity ETF. This isn't a single stock. It's a collection of around 5 companies that have already been filtered for financial strength, consistent dividends, and long-term reliability, which means John isn't betting on one company getting everything right. He's spreading that risk across many. The yield sits around Pasento Santen to Pasento Santen, which is already higher than the SP Goodbye. And more importantly, the dividend growth rate has averaged over Pasento Ju per year, which gives the snowball something to build on, while the price appreciation stays around Pasento to Pasento Q, adding steady long-term growth underneath. It's not flashy, but that's exactly why it works, because this is the anchor of the portfolio, not the part that takes big risks. Once that base is set, John looks for something that does a different job, something that pushes more cash into the system early on, because the faster the snowball gets fed, the faster it grows. That leads him to CubeSmart. This is a real estate investment trust focused on storage facilities. And while the business itself isn't exciting, the numbers tell a different story, with a dividend yield close to Pasendo Gotenku, making it the highest income producer in the entire portfolio. The trade-off is clear: price appreciation is slower, sitting closer to the mid-single digits. But that doesn't matter here, because CubeSmart isn't in the portfolio to grow aggressively, it's there to generate cash flow. Every quarter, it feeds more money into the snowball than anything else, and that cash gets reinvested immediately, buying more shares and accelerating the entire process. Next, John shifts back toward growth, but not the kind of growth that ignores income. Instead, he looks for companies that may start with a lower yield but grow their dividends aggressively over time. That's where Tractor Supply Company comes in. At first glance, the yield sits just above Passantone, which doesn't seem impressive, but the dividend growth rate tells a completely different story, averaging nearly Passantone per year, which means the income from this stock doubles roughly every 4 years. Over time, that small starting yield turns into something much larger. And because the business itself is stable, selling essential goods in rural markets, it keeps that growth going consistently. Then John adds another layer of growth and income through Morgan Stanley. This one sits somewhere in the middle, with a yield around Passantone Tengo. But what makes it stand out is the combination of strong dividend growth and strong price appreciation, both pushing close to Passando 1 usual annually over long periods. This adds momentum to the portfolio, helping the snowball grow faster without sacrificing stability. Finally, John adds the most aggressive piece of the portfolio, something that can bend the curve earlier in the process, and that's Federal Agricultural Mortgage Corporation. This company focuses on financing agriculture and rural infrastructure. And while it's smaller and less well-known, the numbers are hard to ignore, with a dividend yield around Passento Stengo, dividend growth above Passento 9, and strong price appreciation in the mid-teens. This combination of solid income and rapid growth is what accelerates the entire system, especially in the earlier years when compounding is just starting to build momentum. When you put all 5 of these together at equal weight, something interesting happens. The portfolio blends out to roughly a Passento Santenshi dividend yield, which is already nearly double the SP go here. But the real difference comes from the dividend growth rate sitting above Pansanda Juice Chi annually, which completely changes how fast the income increases over time. At the same time, price appreciation averages around Passandochu to Passandochu, meaning the portfolio still grows in value while generating income, instead of forcing you to choose one over the other. And that combination is what makes the strategy work. Not one stock, not one metric, but the interaction between all of them. Each holding has a job. Some generate cash early. Some grow that cash over time. Some stabilize the system. And together they create something the SP Go Hack alone cannot. Now, the only question left is the one that actually matters. Does the math work in real life? Now that the portfolio is built, the only thing that matters is whether it actually delivers the outcome it was designed for. Because a strategy only works if the numbers hold up over time, not just in theory, but in practice. So John starts simple, the same way he would in real life, with Hooter a day going into this portfolio and every single dividend reinvested automatically without hesitation or timing decisions. That's Sansan Lobiago Chandler door per year, consistently feeding the system. And at the beginning, nothing looks impressive because compounding doesn't show up early. It builds quietly in the background. After the first year, John has Sanzane Lobier Gojurder invested, which doesn't change much on its own, but it sets the base for everything that comes next. By year two, the projections show the portfolio growing to around not sure this point. The dividends are starting to appear, but they're still small enough that most people would underestimate what's happening because the snowball hasn't picked up speed yet. Then something shifts. By year Jews, the portfolio climbs significantly higher. And more importantly, the dividend income starts accelerating in a way that's impossible to ignore, because that Passanda Jushu dividend growth rate begins doing exactly what it was designed to do. Each year's income is noticeably larger than the last. Each reinvestment buys more shares than before. And the snowball starts feeding itself instead of relying mostly on new contributions. Then comes the moment that changes everything. Year Dow. The portfolio reaches roughly $5 in total value, and the annual dividend income crosses $5 which breaks down to about action beyond the result in the door. That's the target. Same Judah a day, same discipline, completely different outcome. And when you break down where that result came from, it becomes even more interesting. Out of the total value, a large portion comes from capital appreciation, the stocks increasing in price over time, but almost an equal portion comes from reinvested dividends, money the portfolio generated on its own and fed back into itself. In other words, the snowball built a massive part of the result without John having to contribute it directly. And this is the difference most people miss. They assume the result comes from saving more money. But in reality, a large part of the outcome comes from how efficiently that money compounds once it's invested. To really understand how big this difference is, you have to compare it side by side with the SPJ. Same Judah a day, same starting point, same level of consistency, but completely different behavior. On one side, the SPJs who grows steadily in value, but the income stays small for decades, barely reaching a few $100s per month even after Sanju years. The curve stays flat for most of the timeline and only accelerates at the very end, long after it actually matters for most people. On the other side, John's portfolio starts producing meaningful income much earlier, and once the dividend growth compounds, the increase becomes exponential instead of delayed. By year Ju, the dividends are already noticeable. By year Ju, they start becoming meaningful, and by year Jers, they reach the full target. That's a year difference compared to the SP. Not because the SP Vobit is bad, but because it's optimized for a completely different goal. One path focuses on building wealth first and income later. The other builds income alongside growth from the beginning. And that difference changes everything about the timeline. But after seeing this, John asks one more question. What happens if you push the system just a little harder? After seeing what Jundra Day could realistically turn into, John started thinking differently because the system clearly worked. But now the question wasn't whether it worked, it was how far it could go with just a small adjustment. So instead of starting from zero, John adds something most people actually have but don't use effectively, a lump sum. He has each mangosendo saved up. Not a huge amount, not life-changing on its own, but enough to change how the snowball starts. Instead of waiting years for the portfolio to build momentum, he drops the December Go Send Dora in on day one and increases his daily contribution from Hudo to Sans Dora, which brings his annual investment up to Ichangosher logo dollars per year. Same strategy, same portfolio, same mechanics, just more fuel from the beginning. And this is where the timeline shifts dramatically. After the first year, the portfolio is already close to Niman Hassan Dori because it didn't have to build from zero. It started with mass, and mass is what makes the snowball grow faster from the start. By year Ju, the portfolio reaches nearly Sanju Mais Dor. And now the dividend income is no longer small or theoretical, it's real, generating over Itman Lucine Dor per year, which is already more than Savanduder per month. That's before the snowball even hits its peak acceleration phase. Then by year Juzan, something important happens. The portfolio crosses roughly East Jamander in total value, and the annual dividend income climbs above Sandman John's story, which breaks down to over 9 Dori happier per month. That's the same goal. But now it's reached in Jusan years instead of Juba, and Jusan years faster than the SP Goba path. And when you look at where the value comes from, the pattern is clear again. A large portion comes from price appreciation, but a massive part comes from reinvested dividends, money that the portfolio created on its own and kept compounding internally. John contributed around Jumandora over that period. The portfolio generated more than double that on its own. That's the snowball effect in its purest form. It doesn't just grow, it accelerates. And the key difference between the three paths becomes impossible to ignore. The SP200 takes around 90 years to reach the goal. The structured dividend portfolio with Hooter a day takes Hu by years. And with Ichembang, Head Start, and Sanjudor a day, it takes just Hu's Angers. Same target, 3 completely different timelines. And this is the part most people never fully understand. The snowball doesn't care how much you start with. It cares that you start, and more importantly, what you feed it, because the structure determines the speed. The consistency determines the outcome. And the earlier you build the system correctly, the less time you need for it to work. That's the real difference between following what everyone else is doing and building something intentionally designed for your goal. If you want to see how to build a simple ETF portfolio, starting with Gosendora and scale it step by step into something much larger, click the video on the screen right now.